Imagine this: you've spent 5 years faithfully paying your mortgage, pouring in over $145,000 in payments, thinking you're building equity and getting closer to financial freedom. Then, one decision wipes out all of that progress. You've lost it all, sending you back to square one. What happened? Every year, more than 2 million property owners fall for this, believing it's the ultimate financial hack. But the truth? It's a trap by design, and the worst part is that it makes you feel like you're winning. It's the perfect crime. In this video, I'll show you how banks will use refinancing in 2025 to steal your equity and how you can avoid becoming their next victim. Then, I'll explain how you can actually tilt the playing field in your favor. Here's how the scam works. It begins with feel-good ads about saving money. Banks make refinancing look like a smart move in their ads, crafted to target your financial stress. They make it sound like a win: lower payments, better terms, less hassle. But what they're really doing is weaponizing your trust. Every smiling family in those ads and every happy couple you see is carefully chosen to convince you that refinancing is the responsible thing to do. In reality, it's just a sophisticated trap designed to keep you in their system. Typically, property owners in the United States refinance every 4 to 6 years. If you look at the amortization schedule of a traditional 30-year fixed mortgage, you'll see that during the first 6 years, approximately 75% of your payments go straight to interest. What this means is that, in those early years, you're peeling back very thin layers of interest, barely touching the principal. Each payment feels productive, but it's not. Think of a mortgage like an onion. In the first few years, you're peeling back the outer layers, paying mostly interest and barely reaching the core. When you refinance, it's like putting all those layers back on, resetting all that interest. This leaves you right where you started. Let's break it down with real numbers. Using the median home price in America as an example, which currently sits around $420,000, most people put 20% down and borrow the rest. At a 6% interest rate, this gives you a monthly payment of $2,414. After 6 years, you'll have made $45,881 in principal payments, paying down the loan by $114,000, while $62,000 went straight to interest. After all those mortgage payments, your balance is still $337,563. Then, the bank comes along suggesting you refinance because rates have dropped to 5%. It sounds great: lower payments, more cash flow, but here's what really happens. First, your debt clock resets from 24 years back to 30 years. Second, you lose the $114,662 in interest you've already paid. Third, over the life of your new loan, you'll pay an additional $86,700 in interest. So you've traded over $200,000 in costs just to save $363 a month. It's a deal so bad it would take you 315 years to break even. Banks don't promote refinancing because it's good for you. They push it because it's a recurring revenue goldmine for them. Every time you refinance, they lock in fresh interest payments and tack on fees, resetting your loan. It's a system designed to benefit the banks, not you. Now, I get it, life happens, and you might need cash. If that's the case, here's a smarter move: instead of refinancing, consider a home equity line of credit, HELOC. A HELOC lets you tap into your equity without resetting your mortgage. It works like a credit card secured by your home. You borrow only what you need and pay it back on flexible terms. This way, you keep your mortgage intact, avoid extra fees, and preserve the progress you've already made. Banks find it easier to sell you the same product over and over than to find new customers. Each time you refinance, they lock in more interest payments and collect more fees. But you can turn the tables by making a smart money move of your own, turning it into a recurring revenue model for yourself. Instead of falling into their trap, use their system to set yourself free by leveraging your home's equity to invest in another property. For example, let's say that $420,000 home, after 6 years, appreciates at an average annual rate of 3%, bringing its value to $491,511. You'd have $193,900 in equity, allowing you to access about $100,000 of that when you refinance. Use that as a down payment for an income property. Yes, you reset the loan on your first property, but now you own two properties. This gives you appreciation, cash flow, depreciation, amortization, and tax deductions on two properties instead of one. Here's where it gets exciting. The equity you used isn't your own money, it's borrowed money, which means you've invested nothing out of pocket into the second property. Every dollar it generates, from appreciation, cash flow, and tax savings, is a pure return on borrowed money. That's called infinite ROI, return on investment, and over time, the second property can fund a third, then a fourth, growing your portfolio exponentially. Your tenants, not you, are paying off all that borrowed money. There's no other asset class available to the average person that buys itself and self-liquidates the debt used to acquire it. This is the same strategy banks used to keep you tied down, only now, you're the one collecting recurring income. They use refinancing to trap you, but you can use it to free yourself. Now, here's the opportunity for 2025. The Federal Reserve has already signaled multiple rate cuts over the next 18 months, so refinancing will dominate the headlines. Millions of homeowners will face a critical decision: standby or refi? If you're sitting on equity in your home and choose to leave it there, you're essentially retiring your money before you retire yourself. If you're okay with that, stay the course. But if you'd rather be sitting on the beach with a fruity drink instead of watching your money do so, don't let the banks play you. Turn the tables and play them. This isn't just about owning multiple properties. It's about taking control of your financial freedom. And you don't have to go it alone, in fact, it's often better not to. Building a strong community and support system can save you years on your journey. Remember, the biggest financial mistake isn't making the wrong move, it's making no move at all. You're losing out if you're sitting on equity and not putting it to work. Every year, inflation eats away at the purchasing power of that equity, while real estate values continue to rise. The question isn't whether you can afford to act, it's whether you can afford not to.